Craig, welcome. Sorry, we were
Okay,
just talking about
that's okay.
toxoplasmosis and if it made men more attractive. Have you ever had it?
I use other pheromones to attract people of opposite sex. It must be a peculiarity I live in Cromwell. Must be a Cromwell thing. I use a traditional perfume or a woody vanilla smell, Michael.
Uh, oh, very good. Okay, fair enough. Hey, listen, yesterday, first thing to talk about obviously is the Reserve Bank cutting the OCR by
Yep.
25 points. Um, Enough, in your view?
Oh, well, actually, I just want to give you a bit of background around what must have been a great debate inside the Monetary Policy Committee yesterday or over the previous days, because although it was lowered from 3.5 to 3.25, there was dissension to the committee. And the
Oh,
committee voted 5-1, so there were 6 members, voted 5-1 to lower the rate by 25 basis points, 3.5 to 3.25. I can't recall the last time I've seen that published, but I think it's a first. I might be wrong, certainly
yeah.
in the era of transparency. And so I just want to go through the arguments for and against. So there were two motions on the table. Shall we keep the rate as it is, or should we drop it by 25 basis points to 3.25? Those who favoured 3.5 remain, keep it as it is, were concerned about the CPI rising 2.5%, 2.5% in the last quarter. Inflation expectations, retail and businesses' medium-term expectations are going up, and the economy will recover next year from its lows. And in addition, CPI is not going to finish peaking till about 2.7% on forecasts mid to later this year. So the member who wanted to stay would be saying those arguments are strong enough to leave things as they are. Those that wanted the rate to drop were saying core inflation, so that excludes food and energy, is falling. There's plenty of spare capacity in the economy. Unemployment's going up. There are more labour availability. And global growth, in particular China and US, important trading partners for us, number two and number one, or one and two,
Yep.
is challenged. Growth is challenged by the Trumps or domestic conditions in China. So that was a revealing debate. So the market had been expecting a very straightforward drop to 3.25, but with that tension amongst the members, which I think is great, there's actually a really good debate going on, that it wasn't all one way. There was a bit of a handbrake there. And the uncertainties remain. You just don't quite know where Trump tariffs will end up. In fact, some central banks are giving up on forecasts because it flips around. In particular, countries where you're subject to high tariff, reciprocal tariff regimes like Canada, for example, it's very difficult to forecast for those economies. And also, the RBNZ specifically mentioned the risks around the US fiscal position, just getting worse and worse, adding to debt. The debt pile in the US, I mean, their interest bill is, from memory, nearly $1 trillion, and that's higher than their defence budget of $850 billion. So she's a massive bill that taxpayers have to front up with in the US. And because of that, the governments in the US, because they're issuing more and more debt, the markets have to consider how to absorb all that supply of new bonds they've got to buy. And so last week there was a bit of a strike, a bit of a concern around the auctions, the debt auctions in the US and also in Japan. You may not know, but the 10-year government bond yield in Japan has gone up from a low of 0.8 or so in January to 1.5% most recently, which is a massive rise in the interest rate. So investors are saying, we want to get paid more for taking risks in Japan and risks in the US. So the immediate sort of focus of the market and the people on your call will be thinking, what does that mean for mortgage rates? So the floating rate mortgages have followed the OCR, but because the longer term interest rates remain high, in fact, since January, they've gone up. The 10-year government bond has risen from 4.3 to 4% in New Zealand, and the 5-year bond's done similarly, 3.6 to 4%. So actually, medium to long-term interest rates are going up in New Zealand. half of New Zealand mortgages, according to the RBNZ, will be rolling over June, September this year. So borrowers will be facing choices. Do I stay in floating or do I lock in, at higher interest rates than I could have done in January?
What's your
So it just
advice?
depends. I don't give advice on financial,
Okay, so all right,
but
so I'll
but
rephrase that.
but because
If you
yeah,
had a
but New Zealand
mortgage,
is
what would you do?
well, you can't. The maths you have to do is figure out what's called a break-even rate. So, what extent do changes in either a floating rate or a 3-year mortgage rate have to change in order for them to be equivalently the same? So, or conversely, if short-term interest rates rise again, how long can I stay in floating before it becomes uneconomic and I should have gone into fixed? So I think that's probably the more likely break-even discussion for
Okay.
borrowers to have. If I have 3.25, call it 3.25% floating rate mortgage today, what does that have to rise by in order for me to be better off actually having a higher 3-year mortgage today? And that's the trade-off to think about. And do you know the future with Trump issues overseas? It's particularly difficult, but it tells you from the committee meeting minutes yesterday that actually the Monetary Policy Committee's thinking about actually there may not be a need for further cuts, subject to all those risks.
Isn't it interesting you talk about Donald Trump? Because if I was just reading the first part of this year and looking from the outside as some sort of economic commentator advisor, I'd be thinking, don't worry about all the stuff to do with tariffs and trade barriers and things like that because they are a continual reset, 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 or I'm going to do this, I'm not going to do this. It's game playing, really, at the end of the
Yep.
day. Have a good look instead at what's just gone past through the Republican House, I think, which is the tax package and the spending package, which seem to be, I would suggest to you, enormously stimulative of the US economy. Is that your view too?
Yeah, so it's an extension of the tax regime, so it's a rollover effectively. Yes, so that's why bond markets are concerned. You've got a worsening public deficit, and I think the numbers are like net debt to GDP in the US, something like 100 trillion going to 100% of GDP going to 120% of GDP. So rising quite rapidly. And again, that interest bill continuing to climb and being a drain on taxpayers' revenues and no end in sight to programs, social welfare programs, benefit programs, etc. So relying on a stimulus to create growth and GDP growth and get those percentages back in the box again. But it's not clear to me that growth will pick up with the tariff regime changes in the short term, and the risks are that the GDP numbers don't improve and the fiscal numbers and the debt numbers continue to deteriorate. I mean, you knew
Listen,
that the credit rating agency Moody's cut the US AAA credit rating a couple of weeks ago to AA plus, or in their language, I think it's AA1 from AAA. But they've followed the other credit rating agencies who have already moved. So there's now the US sovereign debt is now not rated AAA anymore, it's AA, which tells you something about tiny risk adjustment, but tells you the direction of travel around people's view of the quality of US sovereign debt.
listen, the other thing that's just come out this morning, I think, is that Fonterra have announced their profit for the year. It's almost $1.2 billion. And they've given an indication for the 25-26 season of the of a $10 a kilo midpoint, which on the calculations that I've just seen published this morning would add something like $15 billion to the New Zealand economy should those figures be translated into reality. our dairy industry is still going gangbusters, isn't it?
Yeah, just one thought to consider. You've got to look at the cost side as well. So, we're talking about the need for dairy farmers to be profitable. So the revenue line is important, and that's a fantastic confirmation of what was signalled the last 2 or 3 months, that it'd be $10 milk fat payout. But what we don't know for every farmer is their break even, their profitability break even. So if your costs have risen from $6 to $8.50, have you got the profitability in there that you had, 2 or 3 years ago? And it'll be different for every farmer. But I'm just flagging that it's not all about the revenue. It's also the costs of farming have gone up enormously. And listeners on your program were well aware of the costs of fertiliser, fuel, energy costs that have been horrific for those producers. But happy days, the revenue side's looking very bright. I agree.
Having said that, one of those costs are rates. Um,
Yes.
and that is something that I think was mentioned by the Reserve Bank. They have control over the trading sector. Well, that seemed to have inflation under control. But in terms of insurance rates and those sorts of non-tradable areas, there's still onward and upward pressure, Craig.
Yes, there is. I think the Auckland Council struck rates just under 6% for next year, 5.8. But that would be an outlier, I would have thought, around New Zealand. Most will be at
Above
least
that.
large single or double-digit numbers for
Yeah,
next year.
yeah, yeah. No, that's absolutely right.
And
Well,
you're right. It's one of those non-tradables where you've got very sticky services type inflation, which is really hard to pull back in. And you're in a better position than a lot of us because you're a council. You'll understand the pressures around rolling out infrastructure and ensuring that it's affordable and it's got to be paid for by somebody. You can't compete and get forever. You've got to somehow generate revenues, and the only way that councils, well, a major way that councils have got to raise revenue is rates. Not all councils have solely rely on rates. Many rely on other sources of revenues, but in a low growth economy, those revenues aren't necessarily growing either.